السلام عليكم ورحمة الله. إن شاء الله today we will take lecture 7 and we will finish chapter 6 efficient diversification, and we will take chapter 7 capital asset pricing and arbitrage pricing theory. Single factor model. What is single factor model? Factor model is a statistical model to measure the firm specific versus systematic risk for particular security or portfolio. So we will make a difference between specific risk and systematic risk, which is market risk. And we can express the distinction between macroeconomic and firm specific, between systematic risk and firm specific risk. By decomposing, we will decompose the excess return into three components as, and we can see here these three components in this equation. Ri equal ERI plus beta IF plus E. And Ri is rate of return in excess of the risk-free asset or risk-free rate. ERI is the expected excess return. Beta I, sensitivity of the security to the macroeconomic factor or market factor. And here beta I will be the coefficient of beta, or that is the coefficient of systematic risk. Beta coefficient will be the measure of the systematic risk for this security. F, that is the main factor, here is market or macroeconomic factors. In this case, F here in this equation, F in this equation will be the unanticipated movement of the market or of the macro factor. E is the impact of unanticipated firm-specific events. So E here will be the unsystematic risk or the firm-specific risk. Single index model. Single index model is a model of stock return using market index, that is the main factor, to represent common or systematic risk factor. And the equation for this model is Ri excess return of security I will be equal alpha I plus beta I, that is the systematic risk, multiplied by Rm, that is the market index, plus EI. EI is the firm specific risk. And we can eliminate this firm specific risk. We can eliminate this firm specific risk by the diversification. So the main factor of this model is beta I multiplied by Rm, or the market index, and beta I is a systematic risk factor. A graphical representation of the single index model, and here we will represent the single index model in this line, and we will call this line security characteristic line. What is security characteristic line? Is plot of a security's excess return as a function of the excess return of the market. This line will show me the relation between securities excess return and market excess return. Estimating the index model. Here is we will see the relation between excess return for security I and excess return on market index. And we will get the historical data for these two factors. And this historical data show me this relation. For example, at this point, or in this time, the return of the market was here, and the return of the security was here. يعني كل point من دول بتعرفني السوق أو الماركت عند الفترة دي أو البيريود دي كان قد إيه، وقصادها كان الريتيرن بتاع السكيورتي فين. From this relation we will get the relationship between these two factors, and the equation of this regulation is here. Ri equal alpha I plus beta I multiplied by Rm plus EI. And this line we will call it security characteristic line, and this line is best fit with this data. دي الخط ده او اللاين ده بيوريني افضل لاين بيوريني العلاقه ما بين excess return of I and excess return of the market. And the slope of the line is the regression coefficient. السلوب بتاع اللاين ده هو بالنسبه لي الريجريشن coefficient اللي هو هنا بيتا. And this beta express what? Express the systematic risk of this security. And EI, this EI is the residual or firm specific risk. How we can measure EI? Measure of EI is I can measure it by this distance. The distance between the point on the diagram, this point, and this regression line, security characteristic line. This distance أو المسافة دي هي اللي بتديني قيمة أو الفاليو بتاعة ال EI أو الفيرم specific risk. Security characteristic line. The line زي ما قلنا قبل كده, the line is best fit with the data in the diagram because it is drawn to minimize the sum of all square deviation around it. The slope of the line is the regression coefficient or simply the beta. Beta is a natural measure زي ما احنا عارفين. Beta هي الميجر of systematic risk. It measures the typical response of the security return to the market fluctuations. لو حصل أي fluctuations في الماركت الريتيرن بتاع السكيورتي دي هيتغير بقد إيه أو يتحرك قد إيه up or down. ده هيتحسب على أساس بيتا أو على أساس الفاليو of بيتا. Residual or firm specific, as we said, firm specific risk is measured by vertical distance between the point on the diagram and the regression line. The greater the beta of the security, كل ما قيمة بيتا بتاعة السكيورتي بتكبر, the greater the slope. السلوب بتاع اللاين بتاعي اللي هو السكيورتي characteristic line will be greater. And what does that mean? That means that the greater the systematic risk. Systematic risk أو market risk will be higher. Average security has a slope coefficient beta of 1. الافريج بتاعت السكيورتيز اللي موجوده جوه الماركت ده او جوه الماركت بتاعي, الافريج slope coefficient بتاع بيتا بتاعها will be equal 1. Why? Because the market beta is equal market beta will be equal 1 and the average بتاع السكيورتي اللي موجوده جوه الماركت دي will be equal 1. An aggressive investment. If I have an aggressive investment, what does that mean? That means that a beta will be for this investment, the beta for this investment will be higher than 1, because the beta of the market will be equal 1. So if my security has a beta coefficient more than 1, that means that I have a security with higher risk or higher systematic risk. So the security has above average market risk. A defense investment, if I have a defense investment, what does that mean? That means that this investment will have beta lower than 1. The security has below average market risk. The average market risk is 1. So if I have an investment more than 1, that is an aggressive investment. And if I have an investment with beta lower than 1, what is that? What I call this investment? I call it a defensive investment. Investors expect the market rate of return this year to be 10%. The expected rate of return on the stock with a beta of 1.2 is currently دلوقتي موجودة to 12%. If the market return this year turns to be 8%. لو الريتيرن نزل from 10% to 8% for this market, would you revise your expectation of the rate of return on the stock? هل في الحالة دي الاكسبكتيشن بتاع الستوك بتاعي هينزل عن ال 12% اللي أنا متوقعاها؟ The expected return on the stock will change by beta times the unanticipated or unexpected change in the market return. So this is beta 1.2, the beta of this security, times the 8% minus 10%. 8% minus 10%. يبقى هحط البيتا واضربها في ال 8% minus 10%. That will be equal minus 2.4%. عشان كده هنلاقي الريتيرن بتاع السكيورتي هينزل بالبرسنتج جي اللي هي minus 2.4%. So therefore the expected return on the stock should be revised to 12% minus 2.4%. So the expected return will be 9.6%. Problem 3. The following figure shows plots of monthly rates of return and the stock market for two stocks, A and B. That is the characteristic security characteristic line of stock A. This is the excess return. That is the excess return. The excess return equal RA minus RF, or the return of stock A minus risk-free rate. And in the horizontal line is the RM minus RF. That is the excess return of the market, or R return of the market minus risk-free rate. And this blue line is the security characteristic line. Security characteristic line. For stock B, the same. The relation between excess return of the security B and excess return of the market. And here is the security B characteristic line. A. Which stock is riskiest to an investor currently holding in a diversified portfolio of common stocks? The diversified portfolio consists mainly of systematic risk. الدايفرسيفايد بورتفوليو لو الانفستور عنده ويل دايفرسيفايد بورتفوليو المينلي ريسك بتاع الدايفرسيفايد بورتفوليو will be the market risk or the systematic risk. Because the with diversified portfolio we can eliminate the specific risk or the firm specific risk. هنقدر ان احنا نقلل من السبيسيفيك ريسك بتاع السكيورتي. لو انا حطيت في البورتفوليو سكيورتي واحده السبيسيفيك ريسك بتبقى عاليه، لكن لو انا حطيت في البورتفوليو more than one kind of stocks فانا كده بزود من الدايفرسيفيكيشن بتاع البورتفوليو، وهنا بقدر ان انا اقلل او اقضي تماما على السبيسيفيك فيرم ريسك، وبيفضل لي عندي بيبقى السيستماتيك ريسك. فالمينلي بتاعي او الريسك الاساسي بتاعي هو هيبقى السيستماتيك ريسك، او بالنسبه لي اللي هو الماركت ريسك. يبقى الماركت في الحاله دي الميجرز بتاع الريسك بتاعي هيبقى بيتا، لان البيتا عندي بتقيس الماركت ريسك. يبقى الماركت بيتا measures systematic risk which is the slope. طب ايه هي البيتا؟ البيتا عندي هي السلوب of the security characteristic line. stock characteristic lines of stock B is steeper. زي ما احنا شفناه كان اقرب انه يكون vertical، اقرب ان هو يكون vertical. فلو هو الستوك characteristic lines of B او stock B is steeper، ده معناه ايه؟ ده معناه ان الستوك B's systematic risk is greater. يبقى systematic risk of security B will be greater than systematic risk of security A. Thus, for this investor, stock B is the riskiest. يبقى الستوك B عندي هتبقى more risky than security A. B, which stock is riskiest to an undiversified investor؟ لو الانفستور ده البورتفوليو بتاعته undiversified. Who puts all of these funds in only one of these stocks؟ يعني هو بيحط كل الانفستمنت بتاعه في one kind of stocks not more than one kind. ده معناه ان انا ما عنديش well diversified portfolio، لا عندي undiversified portfolio. The undiversified investors is exposed mainly. يبقى هنا الريسك الاساسي بتاعي ما هواش systematic risk، لا هيبقى المينلي هو الفيرم specific risk. Stock A has a higher firm specific risk because the deviations of the observations from the SCL deviation عن security characteristic line are larger for A than for B. هيبقى أكثر بالنسبة لسecurity A عن security B. ده معناه إيه؟ معناه إن أنا لو عندي undiversified investor هيبقى بالنسبة له stock A is therefore riskiest to this investor. Now we'll start with chapter 7, that is capital asset pricing and arbitrage pricing theory. Capital asset pricing model CAPM, equilibrium model that underlies all modern financial theory. CAPM دي هي الأساس بتاع كتير قوي من الثيوريز الجديدة أو المودرن فاينانشال theories. CAPM provide precise prediction of the relationship between the risk of an asset. الريسك بتاع الاسيت يبقى بتشوف relationship between the risk of an asset as measured by beta. الريسك ده هيبقى systematic risk، عشان كده هيبقى measured by beta and its expected return. يبقى ال expected return بتاع any security هنحدده على اساس بيتا اللي هي systematic risk of this security. ده اللي بتقوم عليه اساسا الكاب ام. والكاب ام كمان uses principles of diversification، بتقوم اساسا على ان البورتفوليو او اللي انا بشتغل عليها هي well diversified portfolio. علشان كده بتبقى المقياس الاساسي او الميجر الاساسي بتاع الريسك هو قيمه بيتا. And another assumption Individual investors are price takers. They will take the price as it is in the market. They will not affect the price in the market. يبقى هنا individual investors هياخدوا الأسعار زي ما هي، مش هيأثروا على أي سعر. و single period investment horizon, they will invest for one period only. Investments are limited to traded financial assets, only financial assets. There will not be any real assets. No taxes and transaction costs. مش هيبقى فيه لا taxes أو transactions costs. Information is costless and available to all investors. الانفورميشن موجودة لجميع الانفستورز اللي في السوق وملهاش تكلفة. Investors are rational، يعني كل الناس أو كل الانفستورز جوه السوق هم rational، بمعنى إن هم mean variance optimizers، بيقدروا إن هم يوازنوا ما بين ال return and the risk. Homogeneous expectations كلهم عندهم نفس expectations about the future. Resulting equilibrium conditions, all investors will hold the same portfolio. لو احنا عندنا كل الاسsumptions اللي فاتت all investors will hold the same portfolio for risky assets. That is the market portfolio. All investors will hold the same portfolio. That is the market portfolio. Risk premium on the market portfolio will be proportional to the variance of the market portfolio and investors' degree of risk aversion. الريسك بريميوم على الماركت بورتفوليو ده هيتحدد على اساس الفارينس بتاع الماركت بورتفوليو والديجريز بتاعت كل انفستور او الريسك افيرجن، الديجري اوف ريسك افيرجن بتاعته. الايكويشن ان الاي او الاكسبكتد ريتيرن of the market، expected return ERM minus RF, or the expected return of the market minus risk-free rate, will be equal A multiplied by sigma square M, or the expected return of the market minus RF, that is the excess return of the market, will be equal A or the degree of risk aversion multiplied by sigma square M, or the variance sigma square M, or the variance of the market. So the excess return on the portfolio or the market portfolio market will be equal the risk aversion of the investors multiplied by the variance of the market or the risk of the market. Slope and risk premium of market portfolio. How can I measure the slope of the market portfolio or the slope of the cap M beta? The cap M beta, slope of the cap M beta equal E or expected RM, expected return of the market minus RF, that is the excess return of the market, over sigma, over sigma. Sigma is the standard deviation. Standard deviation of the market, sigma M. Sigma M is the standard deviation of the market. That is the slope of cap M or beta. Expected return on market portfolio. Example, suppose the risk-free rate is 5%. The average investor has a risk aversion of A equal to, and the standard deviation of the market portfolio is 20%. Calculate the expected rate of return on market portfolio. Here, ERM, expected return of the expected rate of return on the market portfolio minus RF, that is the excess return, equal A multiplied by sigma square M, or the variance of the market. So I will rearrange this equation, so the ERM, or the expected return of the expected rate of return on the market portfolio, ERM, will be equal RF, that's the risk-free rate, plus A, that is the risk aversion, multiply by sigma square M, or the variance of the market. So the ERM, expected rate of return on portfolio or on the market portfolio, will be equal risk-free rate 5% plus 2, that's the risk aversion, multiply by variance or sigma square, standard deviation square, 20% square, that will be equal 13%. So the expected rate of return on the market portfolio will be equal 13%. Another example. Suppose the average excess return over treasury bills is about 8.5% with a standard deviation of about 20%. Sigma is 20%. To the extent that this average approximate investor expectations for the same period. Number one, what must have been the coefficient of risk aversion of the average investor? Number two, if the coefficient of risk aversion were 3.5, what risk premium would have been consistent with the market standard deviation? This is the equation for number one. ERM, or expected rate of return of market portfolio, minus RF, that is the excess return of the market, will be equal A, that is the risk aversion, multiplied by sigma square M, or the variance of the market. If we rearrange this equation, that is A will be equal ERM minus RF over sigma square M. So A will be, ERM will be 8.5%. That is the excess return of the market over sigma square of, or the variance of the market, 20% square. That is will be 2.125. That is risk aversion. Number two, ERM minus RF equal A multiplied by sigma square M. So that is will be equal 3.5 multiplied by, that is A, or risk aversion, multiply by the variance of the market, 20% square, sigma square. That is will be 14%. That is the excess return of the market. Market portfolio and capital market line, CML. The market portfolio is aggregate of all individual portfolios. يعني الماركت بورتفوليو بتجمع كل، أو هي مجموع كل individual portfolios اللي موجودة in the market. Each investor uses the market portfolio as the optimal risky portfolio. The optimal risky portfolio will be the market portfolio. So I can compare, or I can evaluate my portfolio and compare it with the market portfolio, because it is the optimal risky portfolio in the market. So we will change CAL to CML. What is CLAL? That is the capital asset line. احنا خدناها قبل كده في previous chapter اللي هي capital asset line. And we will use capital market line as in the next figure. Here is the capital market line, and here is the relation between expected return and sigma or standard deviation, and here is M. M is the market portfolio, and here is the sigma of this market portfolio and expected return of this market portfolio. And here RF, risk-free rate. The line between the RF and M is the capital market line. Capital market line, and M is the optimal risky portfolio. Expected return and risk on individual securities. Risk premium on an individual security will be proportional to the risk premium, that is the first factor, the risk premium on market portfolio. The second factor will be beta coefficient of the security on the market. And here is the equation. ER I, or the expected return of security I, will be equal RF, that is the risk-free rate, plus beta of this security I, multiplied by excess return on the market, ERM minus RF. And here an example. Suppose the risk premium of the market, RM minus RF, is equal 8%, and beta of X stock is 1.25, and beta of stock Y is equal 0.6. The risk-free rate RF equal 3%. Calculate the expected rate of return on both securities. We want to know the expected rate of return on both securities, and we will use the previous equation. The equation is ERX, expected return of RX or stock for stock X, will be risk-free rate 3% plus beta of this security, that is 1.25 multiplied by the excess return of the market, which is 8%. So the expected return of stock X will be 13%. And the expected return for stock Y will be equal risk-free rate 3% plus beta of security Y 0.6 multiply the excess return of the market 8%. So the expected return of stock Y will be 7.8%. Security market line, SML graphs individual asset risk premium as a function of asset risk beta. Here is a security market line. And what is the difference between security market line and capital market line? In capital market line, the relation is between expected return and the standard deviation sigma. But here with security market line, we will see the relation between expected return and beta systematic risk, and beta that is the systematic risk of the securities. So here is security market line, and here is market or optimal market portfolio M. So in this point, the beta of M, as we said before, will be equal 1. And ERM, that is the expected return of the market. Here RF is the risk-free rate, the line between RF and M, that what we call security market line. Security market line, SML. الفيرلي برايسد securities plot exactly on SML. هتلاقوا ان كل السكيورتيز اللي هي البرايس بتاعتها فير او عند الفير برايس، هنلاقي ان هي موجوده exactly على الاس ام ال، مش تحتها ولا فوقها. according to cap M، الايكويشن اللي خدناها قبل كده، all securities must lie، لازم تبقى موجوده on the SML in market equilibrium. لو الماركت بتاعي في السيتويشن بتاع الايكويليبريم، يعني كل شيء متوازن والماركت بتاعي متوازن، هنلاقي ان كل السكيورتيز هتبقى موجوده على الاس ام ال ده according to الكاب ام. طيب لو stocks underpriced stocks plot above the SML، لو الستوك بتاعي underpriced يبقى هنلاقي ان الستوكس دي هتبقى مش موجوده على الاس ام ال، لا هنلاقيها above the SML. ده لو كانت underpriced. طيب لو كانت overpriced، لو الستوك بتاعتي overpriced هنلاقيها برضو مش موجودة على الاس ام ال، لا هيبقى الاوفربرايسد ستوك بلوت below the SML، هنلاقيها تحت الاس ام ال، وده السيتويشن بتاعي disequilibrium، يبقى انا مش موجودة في التوازن، لا هتبقى عدم التوازن. The difference between the fair and actually expected return. طيب لو الكاب ام طلع لي ان الفير expected return هو مقدار معين او رقم معين، لكن لقيت ان الاكشوالي expected return اللي موجود فعليا كان مختلف عن الفير expected return، يبقى في الحالة دي هيبقى في difference between the fair and the actually expected rate of return on the stock that we will call the stocks alpha. The stocks alpha. Alpha means, what is the meaning of alpha? Alpha means abnormal rate of return. Abnormal rate of return is the difference between a fair expected return and actual expected return. That is the abnormal rate of return on a security in excess of what would be predicted by an equilibrium model as CAPM, and we will see that in the next example. Here is the example. Suppose the return on the market is expected to be 14%. That's the expected return of the market, or ERM. A stock has beta of 1.2 and T-bill rate is 6%. That is the risk-free rate. If one believes that the stock will provide a return of 17%, that is the actual return. State if the stock is underpriced or overpriced. Here we will use CAPM. According to SML, the expected return should be, according to the CAPM equation, ERI, or the expected return of I, equal RF plus beta, multiplied by ERM, expected return of the market, minus RF, risk-free rate. So the expected return or the fair return of security will be equal RF 6%, that is the T-bill rate, plus beta 1.2 multiplied by market return, expected market return 14% minus RF 6%, that will be 15.6%. So that is the fair return. But the actual return is 17%. So alpha will be equal actual return minus fair return. So alpha will be positive 1.4%. If alpha is positive, what does that mean? It will mean that this stock is underpriced. Underpriced stock because it plots above the SML, and we will plot it above SML line, offering too high of rate of return. Here the actual return is higher than fair return, or high of the rate of return for its level of risk. For this level of risk, 1.2 here, the fair return must be 15.6, but this security gives us, or actual return of this security is 17%. So we are here in a disequilibrium example. SML, as we said before, is the relation between expected return and beta. And here is the market portfolio with beta always equal to 1 and RM or return expected return of the market equal 14%. And at SML is equilibrium situation. If we are in equilibrium situation with beta or when the beta or systematic risk of the stock is equal 1.2, the fair return of this stock must be equal 15.6%. But when the actual return of this stock with beta equal 1.2, if the actual return will be equal 17%, here we are in this equilibrium situation, because the return of this, the return or the actual return of this stock is above SML and is above the fair return. So alpha will be positive, and alpha will be the distance between SML and actual return. And this stock is underpriced stock. If the actual return of this stock is under SML, so alpha will be negative, and this stock will be overpriced security. Now we will talk about the second theory in this chapter, arbitrage pricing theory, APT. Concept of arbitrage, exploitation of relative mispricing among two or more securities to earn less profits. الاربيتراج هنا الفكره بتاعتها ايه؟ بان في investors، الانفستورز دول عايزين يستغلوا ان في بعض السكيورتيز mispricing، بمعنى some securities have a higher return than others and lower at the same time at lower risk than other securities. فبيعمل الاربيتراج. Arbitrage arises if an investor can construct a zero investment portfolio with a sure profit. هنشوف إن شاء الله في next example what is zero investment portfolio و how investors can make profit with this portfolio. Inefficient markets, profitable arbitrage opportunities will quickly disappear. طبعا ده لأن في efficient market information available to all investors، عشان كده بيبقى الكل في نفس الوقت بيعمل الاربيتراج، ولأن كله في نفس الوقت بيعمل الاربيتراج الاوبورتيونيتيز دي بيقدر يستغلها، فبسرعة الاربيتراج quickly will disappear. Example arbitrage portfolio. Mean return and standard deviation for portfolio A, B, and C. This portfolio has a mean return of 25.83% and standard deviation of 6.40%. That is the risk of this portfolio. For D, the mean return is lower, 22.25%. At the same time, G has a standard deviation higher than portfolio A, B, and C with standard deviation of 8.58%. The same current price of stock A, B, C, and D. كل الستوكس اللي عندي at the same price which is equal $10. هنا بيبقى عندي opportunity for arbitrage. ليه؟ لأن عندي portfolio with higher return A, B, and C, higher return and lower risk، ودي lower return and higher risk، وكلهم عند نفس الكرنت برايس اللي هو 10. هنعمل الاربيتراج ازاي؟ What is arbitrage action and what are the returns? the investors will short sale 3 shares of D and take the funds from this short sale to buy 1 share of A, 1 share of B, and 1 share of C, and for portfolio B. The funds, as we said, from the short sale are used to acquire shares of A, B, and C. هناخد الفلوس دي بتاعة الشورت سيل من دي ونجيب بيهم أو نشتري بيهم A, B, and C ونعمل البورتفوليو بتاعتنا اللي هي B. Investor would earn زي ما شفنا A, B, and C بتحقق higher return، يبقى الانفستور would earn higher rate on the investment than he would pay on the short sale. لما بعد كده بعد وقت هيلاقوا ان هو حقق higher return من ال A, B, and C than he would pay لو التكلفة او اللي هو هيدفعها لانه عمل short sale لدي. The net investment is zero. أنا هنا عملت short sale ل 3D، أخدت $30 من الشورت سيل دي وهشتري بيهم ال 3 shares A, B, and C. يبقى هنا ما حطيتش أي investment، الانفستمنت is zero، ما فيش أي investment. اللي خدته من الشورت سيل هحطه أو هشتري بيه ال A, B, and C. And the investor would earn the spread، لكن هياخد في نفس الوقت يبقى حط زيرو انفستمنت واخد الريتيرن اللي هو السبريد between D and portfolio. هياخد الزياده في الريتيرنز في بورتفوليو A, B, and C عن اللي هو D. Expected rate of return. ABT or arbitrage theory assumes that there are multiple systematic factors, not only one factor like in CAPM theory. CAPM theory assumes only one factor, which is market factor. Here, there are multiple systematic factors that may affect any factor. I expect that this factor will affect the portfolio. I can put it in this equation. So there are multiple systematic factors that may affect the expected rate of return on the portfolio, such as business cycles, interest rate, and inflation rate, and so on. Any factor, I expect that this factor can affect the expected rate of return on the portfolio. And the equation for ABT is expected return for portfolio B will equal risk-free rate plus beta of factor 1 multiplied by expected return for this factor 1 minus RF excess return for factor 1 plus beta systematic risk for factor 2 multiplied by excess return of factor 2, which is expected return for factor 2 minus RF or risk-free rate. Let's take an example. 2-factor portfolios 1 and 2 have expected return for this factor, expected return for these factors 10% and 12%. The risk-free rate is 4%. Beta, systematic risk, on the first factor is 50% and on the second factor is 75%. So calculate the total expected return on the portfolio. Expected return for portfolio B equal risk-free rate 4% plus systematic risk or beta for factor 1 multiplied by expected return for factor 1 minus 4%, that is the risk-free rate, plus 75% beta 2 or systematic risk for factor 2 multiplied by excess return of factor 2, which is expected return 12% minus 4% risk-free rate. So the expected return for portfolio B according to ABT or arbitrage theory will be 13%. If I have third factor, I will put it in this equation and so on. ABT and CAPM compared. ABT applies to well-diversified portfolios and not necessarily to individual stocks. أقدر أطبقها على ال well-diversified portfolios مش بس ال individual stocks. ABT is more general. زي ما احنا شفنا بنقدر ان احنا نستخدم فيها more than one factor, is more general in that it gets to an expected return and beta relationship without the assumption of the market portfolio. زي ما شفنا في الكاب ام كان there is only one factor which is the market portfolio. Here we can use any factors ممكن ان هي تكون هتأثر على البورتفوليوز اللي موجوده. ABT can be extended to multi-factor models. يبقى ممكن ان انا ABT ممكن اوسعها واستخدم فيها كتير قوي من اللي هي المالتي فاكتورز موديلز. كله زي ما شفنا ممكن يكون جوه كل موديل اكتر من فاكتور وطبعا اكتر من بيتا. That is the end of this chapter and we will continue with the next chapter in next lecture إن شاء الله. السلام عليكم.